Julene Snyder, and I'm the audit partner, one of the audit partners here at Jacobson Jarvis, and I'm going to talk to you today about financial reporting standards that are changing for not-for-profit organizations. The Financial Accounting Standards Board has changed some of the standards around how financial statements are reported for not-for-profit organizations, and these standards will be taking effect for calendar year ends December 31st, 2018, or for fiscal year ends in 2019. So I want to tell you a little bit today about what you can expect from these changes. One of the main changes is the way that we talk about restricted net assets. So as you may know, currently we have three classes of restricted net assets. We have temporarily restricted net assets, we have permanently restricted net assets, and we have unrestricted net assets. But these titles or these terms have been confusing to the users of the financial statements for many years. So in the future, when we adopt this new standard, there'll really be just two classes of net assets. We will have net assets with donor restrictions and net assets without donor restrictions. This may sound like we're actually reducing the amount of information that you need to track in your financial reporting systems, but that is actually not the case. Coupled with the change in the terminology of the restricted net assets, there'll also be expanded disclosure requirements around the types of restrictions on those donor dollars, and you will still need to be able to track how much was restricted for various purposes, how much was time restricted, how much was maybe the corpus of the original endowment versus how much has been accumulated to date. So some changes in the language, but continued need to track the various types of restrictions similar to the way you've been tracking them currently. One of the other major changes in this financial reporting standard is increased disclosure around liquidity. So going forward, we'll have a footnote disclosure that talks about the qualitative aspects of the liquidity of the organization, as well as a quantitative calculation of liquidity in the notes to the financial statements. The qualitative disclosure has to do with your organization's philosophy around liquidity. It may have to do with governing boards' reserve policies. It may have to do with availability of credit. It may have to do with policies related to the level of cash on hand that you might have for your organization. There is no particular right answer. It's just about disclosing what your organization's policies are. The quantitative analysis, the quantitative disclosure that goes into the financial statements will be a calculation of your total financial assets, less those assets that are not available for general operations in the next year. So you may start with your cash and your investments and your promises to give, and then subtract off those that are restricted for long-term purpose, such as your endowment, or those resources that you have on hand that are restricted to maybe a capital project, which is not an ongoing operating activity. And then you will actually get a number that will represent available cash or your liquidity. So that is going to be a new and completely different disclosure from those that we've had in the past. There are some other changes in the financial reporting standard as well. Some of the changes relate to how we disclose investment returns. We're actually having somewhat less disclosure with respect to investment returns, which will make that disclosure easier to put together and maybe a little more transparent from one organization to the next. There are changes in how the cash flow statement might look. There are also some changes for the organizations that choose to release net assets related to capital improvements over time, as opposed to releasing those restrictions when the assets are placed in service. If you are one of those organizations that releases assets over time, they're going to eliminate that opportunity to do that, and so you'll be releasing those net assets early. So there are changes coming. Again, the two most important changes that will affect almost every not-for-profit organization are the change in the terminology around temporarily, permanently, and unrestricted net assets. Again, going with net assets with donor restrictions and net assets without donor restrictions, and the expanded disclosure around liquidity.